What they're trying to do is slow the business cycle down, because that's how you get rid of inflation. Now, always at the bottom of every business cycle, whether it was 1990, 2000, 2001, 2008, 2020, always something breaks because of rates and a slowing economy. So that's just a function of what happens in a business cycle, much like there's a boom at the peak of the business cycle and usually kind of excess leverage and excess optimism. So I don't think they tried to break it. Now, it's coming out that, obviously the Fed kind of knew that the regional banks weren't great. We also know the pension system's a problem. We also know there's a number of things that can be a problem in this system when you've got a globally indebted situation like we've got today. The world has never been this far in debt, and no country in world history has ever been as far in debt as the US is as a percent of GDP. So it's problematic, but that's just a function of the business cycle. The observable relationship, because it's a 97.5% correlation between the G5 central bank balance sheets and the S&P 500, is every time it grows by 1% or shrinks by 1%, the equity market moves by 2%. So we've got a clear relationship. And so, I don't know, we just increased the balance sheet by whatever it was, 5%, let's say. So therefore, equity markets go up 10%. That's roughly how it works. However, NASDAQ goes up at a multiplier of about 1.4 times the S&P because it's got a technological uptrend, and it's probably accelerating as AI, robotics, and all of these things come in. And crypto's got a much bigger multiplier. So let's go back to the last time we saw this, which was December 21st, 2018. The Fed just stopped. They're not going to decrease the balance sheet, not going to raise rates any further. Over the next 6 months, crypto was up 300%. So Bitcoin did 300 and something percent. The exponential age stocks, which are the really kind of growthy ARK style stocks, they were up about 30%. The NASDAQ was about 22%, something of that magnitude. The S&P was about 15%. And so we can see that relationship happens. So assets will go up according to the balance sheet. I think the balance sheet goes up significantly, 30% plus over time. Therefore, the equity market can go up 60% in the S&P, maybe more. So new all-time highs in the next 12 months or so. NASDAQ gets there sooner because of its relationship. Crypto moves very fast. I got into Bitcoin in 2013 because I lived the European banking crisis and obviously the financial crisis. But the European banking crisis was very similar to what's happening now. The local bank in the village that I went in went under and took everybody's deposits. They bailed them in. We had a run on deposits, liquidity issues. They were invested in things that were illiquid, which was real estate. Real estate market had come under pressure. Very, very similar. Too many small banks in Europe. And so Draghi backstopped the whole lot. So I saw this and I realized that there was no trust in the financial system, i.e. nobody knew who owned what when Lehman went under. And they were terrified of others going under because of the same issue, because the daisy chains of collateral are everywhere in this market. And then when you realize in a bank, you don't actually own your money. And people are now realizing that. And the treasurer and the Fed are like, well, we'll just pretend that it's okay. That drives people into this parallel financial system. I got into Bitcoin in 2013 for exactly this reason, and have been an active participant of the market ever since. And so I think what Balaji is saying is, listen, guys, here's the life raft. You can take it. Now, Bitcoin's relationship with the Fed balance sheet is really interesting because it goes up exponentially. So if I look at it versus M2 year on year or the Fed balance sheet year on year, it massively outperforms in the bull market and then pulls back when the liquidity comes out of the system again, but it keeps going up. So yes, I think there is a potential setup here for Bitcoin and the whole crypto market actually to be shockingly strong, more like 2013 than 2019. 2019, we had that big correction, and that was partly due to this G5 central bank balance sheets. Some of them were contracting over that period of time, and it pulled back the crypto market. This time around, I don't think we're going to see that. I think we're going to see all of the central banks falling into place. because there's banking issues both in Europe and the US, and China has its own issues. So that they've all got the same issue, which is debt. They're all going to have to stimulate. So I think it's more likely to play out like 2013, which is very squeezy, then sideways consolidation, then very squeezy. Because, every time we go through these cycles, more and more people understand what the benefit is of Bitcoin. And now we've got 300 million people that have used Bitcoin and other crypto. The next time around, it'll be 1 billion people, or 600 million people, or whatever the number is. And those people will have been awoken to the fact that there is another way out of this. Now, the issue is, as we all know, is Bitcoin is extremely volatile. So it's very hard to think of it in terms of, well, it's a wealth preservation asset because people's time horizon is too short. But if you hold it long enough, it does extremely well. It does better than the Fed balance sheet, better than any other asset in existence. But people get freaked out by the up and down move. But if they just zoomed out, they see it does a phenomenal job at opting out of the financial system over time. But, maybe you need to keep liquidity and other stuff for when you need it, as opposed to the crypto cycle, which can be quite vicious. So there's two levels for what a bank is. It is the deposits that they have. That's what makes them a bank. And then it's what they do with the deposits. They invest them. So in a normal course of events, banks make business by something called the steep yield curve. So they borrow at, let's say, 2% interest rates, i.e. they pay you 2% on your deposit, and they lend it out to the market at 5%. That's the yield curve. So that's a longer term duration that they take the risk on. The issue is the yield curve got massively negative. In fact, the second most negative yield curve since 1980. So that means that the banks ordinarily would have to pay you 5% or 4% interest on your deposit, but then they invest it in the bond market in 20-year bonds or 10-year bonds or 30-year bonds, and they're actually getting less money. So they're losing money every day. So what they did is artificially change the yield curve. So they said, well, we're actually going to give you 0.5% interest on your money, and then we can lend it out in the bond market at something different, at a higher rate. So they've manufactured a steeper yield curve. The issue is people have the freedom to move their deposits. So they can move their deposits out of this 0.5% world into a 5% world of CDs, Treasury Direct, money market funds. So people are incentivized to move their deposits because the rate of interest is actually the highest we've seen for a long time. So people are incentivized to do that. That means deposits shrink from the system. As they shrink, you have to unwind the bets that you had at the long end, the longer maturity bets. Now, the problem is those are all underwater because the Fed raised rates so much. So then they've got losses, mark-to-market losses. But to collapse the deposit base, you have to realize those losses. Normally, you can just leave them on your book as mark-to-market accounting. You don't need to worry about it. But in this case, you have to do something about it. Suddenly, poof, they're all got no money. So that's the real issue here. Now, there is a big shit fight going on about what people should do about it, what the government should do about it, what the Federal Reserve should do about it. People say, well, if people are getting scared now because they saw Silicon Valley Bank and Signature Bank go under, well, we should just guarantee deposits in the system. Okay, sounds great. Problem is, it doesn't get rid of the actual issue. The actual issue is the rates are too damn high. So the banks can't make any money. So if they just guaranteed the deposits, people still go to Treasury Direct and get their 4.5% or 5% yields. So it doesn't stop it, slows it down somewhat, but it's still a huge problem. The only answer here, the only answer that they have is to massively cut rates, and I think 300 basis points plus, and also undertake QE.